Welcome back to your weekly markets update. Last week the story was all about inflation and the American consumer, and this week we're watching whether that story gets confirmed or complicated, while the Middle East continues to keep energy traders on edge. Let's start with inflation. Wednesday brought the July Consumer Price Index. Headline CPI rose just 0.1% on the month, with the annual rate easing slightly to 3.4%, down from 3.5% the month before. Core inflation, which strips out food and energy, also came in at a modest 0.2% for the month. On the surface, that looks like continued disinflation. But dig a little deeper, and the picture is murkier. Energy costs remain elevated year over year, and annual inflation is still running hotter than wage growth. That means for a lot of households, prices are still outpacing paychecks, even as the headline trend cools. One day later, Thursday's Producer Price Index told a friendlier story. PPI for final demand was flat on the month, unchanged, coming in below expectations for a modest rise. Services prices ticked up slightly, but goods prices actually fell. That's notable because PPI often acts as a leading indicator for consumer inflation down the road. A soft PPI print gives the Fed a bit more room to breathe, and markets took it as a mildly dovish signal. Stocks pushed to fresh highs on the news. Then Friday delivered the wildcard, retail sales. And this one surprised to the downside. Headline retail sales fell 0.6% in July, badly missing expectations for a small gain, and marking the first monthly decline since last October. Auto sales, gasoline stations, and especially online retail all pulled back. Non-store sales dropped over 2%, partly a hangover from spending that got pulled forward into June's Prime Day promotions. Still, on a year-over-year basis, sales are up 5%, and the broader spending trend for the spring and summer remains positive. Put those three reports together, and the takeaway for last week is this. Inflation pressure is easing at both the consumer and producer level, but the labor versus prices squeeze on households is real, and consumer spending just hit its first speed bump in 9 months. Now, over to energy, where the US-Iran standoff remains the single biggest wildcard for markets. Crude prices have been on a roller coaster for months, tied almost entirely to the fate of the Strait of Hormuz, the narrow waterway that normally carries about a fifth of the world's oil. A ceasefire earlier this year briefly calmed things down, but talks over fully reopening the strait to commercial traffic have repeatedly broken down. Just last week, Brent crude jumped roughly 5% in a single session after doubts grew that Washington and Tehran would reach a deal, with Iran insisting the US must lift its naval blockade first. Brent is now trading in the mid to high $80s a barrel, well off the extreme triple-digit spikes seen earlier this year, but still carrying a heavy risk premium. The bottom line for markets: as long as Hormuz remains a bargaining chip rather than a settled issue, expect energy prices to stay a source of volatility, and a wildcard input into every future inflation report. That's your week in review and the week ahead. Stay tuned for updates as the data and the diplomacy develop.